All right, Zach. This might be easier just to kind of walk you through, just as if we're working through a QuickBooks account. So I'm just going to delete out a few things here real quick. So what we're going to do is this is just a fictitious business here. So I'm just going to go in. I'm just going to make some journal entries. Okay. So we're going to say for the year 2024, we had sales of $100,000, and we had some expenses. Just going to call it cost of goods sold. And we're going to say we spent $50,000 for the year. So in accounting, our debits have to equal our credits. And so now we have an offset. So we collected 100,000, we paid out 50. So now we have a bank account which holds $50,000. So where we see this information is we go through and we look at our company financials. So we have profit and loss and we have a balance sheet. So our profit and loss in this situation is, and I'm going to see if I can bump this up so you can see a little bit better. Okay, so in this situation, our income from sales is $100,000. We had $50,000 of expenses or cost of goods sold, and so our net income is $50,000. Okay, now we're going to go and we're going to look at our balance sheet. And our balance sheet now has $50,000 of cash. And then we also have owner's equity of $50,000. That owner's equity is coming from the net income from the profit and loss. And so this $50,000 is where your question is. If I distribute out that $50,000, how am I taxed? Well, I'd have to distribute out the $50,000 and it reduces our equity. Okay. So first things first, when we go to do taxes as an S corporation, we are taxed on this $50,000. Whatever our net income is at the end of the year, that net income is going to flow up via a K1 up to your individual tax return, and you're going to pay income taxes on it. So now this $50,000 of equity and $50,000 of cash, this has already been taxed income. Okay. So now if we were a C corporation and we distributed those funds out, so we'll make a journal entry and we say we're going to pay ourselves a dividend of $50,000, then our offset is our bank account of $50,000. So now if we look at our balance sheet, we don't have any more cash. Cash is gone, it's been distributed out, and we paid $50,000 of dividends. So as a C corporation, this is where double taxation comes in. Because not only did you pay tax on $50,000 in the C corporation at a flat tax of 20%, you now have to pay a dividends tax on your individual tax return at the capital gains rates. And so in essence, you're being double taxed. As an S corporation, we don't call these dividends. So what we do is we actually call this just a distribution. So now what happens, it's the same scenario. We had $0 of cash left because we distribute those funds. As an S corporation owner, we don't have to pay the double taxation on this amount. We just get to distribute it up to ourselves individually because the $50,000, this owner equity, is just the net income from here that's already being taxed on your individual income tax return. So that should make a little bit more sense to you. So the question is, when we make $50,000 in an S corporation, the IRS says that if you just distribute out all those funds to you without paying a reasonable compensation, then the IRS could go back and say, hey, out of all that $50,000 of distribution, we're going to go back and we're going to call it all wages, or officer compensation is how we put it on a tax return. And that's going to be an expense. So now in this situation, when we go and we look at our profit and loss, this is how it would look. So we would have our income of $100,000. We'd pay $50,000 of cost of goods sold, but we have to pay ourselves a reasonable salary in an S corporation. That's because the IRS wants self-employment tax on that income. So what the IRS says is, okay, you made $50,000. You need to pay yourself a reasonable salary as an officer of the corporation. So what we usually do is we typically do, we'll just say 1/3. So if we take 50,000 divided by a third, that's $16,000. So we'd come in here and we'd say, okay, officer compensation, we want that to be $16,000 here. And then we got to change this to 16,000. So now what's going to happen is, see how our net income went from $50,000 down to $34,000. So now the IRS says, hey, pay yourself a reasonable salary. That's the $16,000. We now have to pick this up as W-2 income, but we get this $16,000 as a deduction on our S corporation return. We pay our self-employment tax on this $16,000. Now we're left with $34,000 in the bank. So now, because we're an S corporation, we can distribute this $34,000 and we don't have to pay all that self-employment tax that we had to do over here. So we're saving tons of money in taxes. Now, all we have to do is we can distribute those funds out. So we do a journal entry, and you do this just with your bank, and you would distribute out $34,000 and we'd call it a distribution. Now in this scenario, our cash is gone. We paid tax on our $34,000 on our K1, but we had $50,000 profit, and then we pay tax on our $16,000 through a W-2, all done through our individual tax returns. Okay, where you're kind of getting caught up is with this being a C corporation, you would have to distribute out those funds. So your next question would be, well, why would I take a distribution? Why not just loan myself the money, right? All right, so we can do that. So we can say, hey, don't take this out as a distribution. We want to set this up as a loan from a shareholder. And I hope I get these all right. Okay, so now we have a loan from shareholders. We didn't take those funds out as a distribution. Now what the IRS is going to say is, okay, you're loaning those funds to the corporation. You need to charge yourself interest. The business needs to be paying you interest for the use of these funds. It just doesn't make sense, because now you're going to be paying tax on interest income on a loan that you just did to yourself when you could have just distributed the funds out to yourself. So hopefully that makes a little bit more sense. I know it's super confusing. The biggest difference is just really understanding the difference between a C corporation and an S corporation. So in a C corp, you still should have the officer compensation because you're working for the business. But where it gets a little bit sticky, we're going to delete that out. Just now we're back. We have 34,000 cash. We have our profit, 34,000, which is coming from our profit and loss statement. So as a C corporation, what do we do with those funds, right? So the things that you can do as a C corporation is you can pay those out as a dividend, and each of your shareholders are going to get some of this $34,000, but they have to pick it up as income on their individual tax return as dividend income. So we're being double taxed because we still have to pay tax on this $34,000 as a C corp. We get the funds in here, we distribute it out. Now we have to pay dividend income on our individual tax returns, whoever the shareholders are. So what corporations have to do is decide, okay, how am I going to use these funds? Are we just going to distribute the funds out to the individual shareholders? They can get that $34,000. They can hopefully invest it to however they want. They can live off those funds. Or as a C corp, if we're going to retain these funds, we have $34,000. Do we just go ahead and reinvest that $34,000 back into our business? So now we're going to spend the $34,000 and say we buy some equipment. Okay, so now we reinvested the $34,000 into equipment. Now we have zero income, so we don't have to have any income tax on this side. And we didn't have to, we cleaned up our balance sheet. We don't have anything. We spent all of our cash. We don't have any net income or equity coming from our net income. And we didn't distribute those additional funds out to our shareholders to be taxed. And so that's a hard decision for every corporation to make. So when I'm looking to invest in companies just like you are, I'm looking for companies that are going to be growing that shareholders' equity. If they can get a return on investment greater than I can, then I want to leave my funds inside this C corporation, this big corporation. If I can invest better than the C corporation, then I would say, hey, I would rather have you distribute the $34,000 out to me and let me invest those funds because I can get a greater rate of return. So, but what happens is, and that's where all your question is coming from, is if a C corporation doesn't distribute out those funds and we have the $34,000, if I own a C corporation, then I could take the $34,000 from my bank account, from my equity, and I could loan that to another entity. So most of the individuals that come through Wealth Ability, what they do is when they have this $34,000, they don't want to distribute it out as a C corporation, have to pay that double taxation dividend. So now they would just loan the $34,000 to another entity that would use those funds for a down payment to buy a piece of real estate. So hopefully that makes a little bit more sense. If you still have questions, let me know. But I know it's confusing. But once you understand the concept, then it'll make sense.